Hey everyone, me Kevin here. I figured it out. This is exactly what happens every time after we buy the dip in this stupid, dumb, convictionless market. Here we go. All right, folks. Well, after that shell shock, we've got a lot to talk about, and we've got to go deep on some very important things. First, we're going to talk about a Fed minutes warning that actually came from JP Morgan. I thought this was very interesting. We're going to talk about this. We're going to talk about an evacuation happening in Russia. We're going to talk about which stocks are holding up, and are they potentially a value trap? We're going to talk about some critical levels that you've got to write down for TA. We also have to talk about inflation and some special things that folks are trying to say, oh, inflation will peak in April because it was so high last year. But wait a minute, is there a little bit more under the hood that we got to talk about regarding that? Talk about a little bit of a BTC heads up, a portfolio update, small portfolio update for me, and we'll talk about some other stocks hitting low. So we got a lot to cover here. Let's get right into it. This video is brought to you by Masterworks via the link in the description down below. And of course, if you think we are potentially heading into rough times and you want to prepare yourself to make sure you're aware of potentially when the best buy back into stocks or how to get the best deal in real estate, especially if the market starts rotating down in real estate, check out the programs on building your wealth down below. You want to learn those before we potentially have rough times ahead in the markets. So check that out via the link in the description below. Okay, let's get into this. So, look, we've known this since December, January at this point, and I've warned about this coming for earnings season, that bad news is bad news and good news is also bad news. And that's because some of the guidance that we're getting just isn't as peachy as we would hope, and we're facing these potential fears that if growth slows at the same time as we have high inflation and the Fed has to choose, they might end up choosing to fight inflation, pushing us into a forced recession, which would not be good. That's obviously not what we're looking for. Others are now trying to create stagflation ETFs, so that way you can invest your money instead of into like an innovation ETF like Kathy would, but into a stagflation ETF that'll invest your money into a mix of gold, real estate, and cash, which is kind of surprising, especially since mortgage rates are skyrocketing. And some folks are starting to wonder, is it possible that we could start seeing some slowdown in real estate pricing? So first, let's talk about JP Morgan and their warning about the minutes. Kelsey Barrow was on Bloomberg this morning, and she mentioned that the Fed minutes in January were missing something that were talked about in December. They did not include as many references to transitory, gradual, steadily, and measured as we have previously had in other meetings. Now, in December, we saw the removal of things like transitory and some of these others. But one thing that was present in the December meeting was a reference to how in the past they had reduced rates in a gradual and predictable manner, that they had offloaded the balance sheet in a gradual and predictable manner. This was missing from the January minutes. And this is really because we are starting to see the Federal Reserve turn a little bit. Even the more dovish members are turning a little bit, realizing we might have to get a little bit more aggressive. Now, we're going to talk more about doves versus hawks. But Kelsey at JPM mentioned that the big thing the Fed should do right now is if the market starts pricing in that 50 basis point hike in March, the Fed should absolutely take it. That the Fed has to regain that credibility and show they can actually fight inflation. And we're starting to see a little bit of this shift amongst the doves and the hawks. Remember, the doves at the Fed are folks who generally want to go slowly and measured and just want to wait for the data to improve. And the hawks are those at the Fed who are like, no, we got to deal with this. We potentially have to Volcker the economy, which is a reference to Paul Volcker in the 80s, raising rates to like 18% to stamp out inflation, forcing an ugly recession. Now, what we heard, obviously, from Bullard over this last week here is that he wants rates to be 1% by the summer, by July 1st. But he's a hawk. But over the last 24 to 36 hours, we also heard from some of the more dovish folks, like Loretta Mester. And she says that rates should rise faster than after the Great Recession, and says the Fed will have to move more aggressively unless there's a material change in the economy, aka all of a sudden inflation finally rotating down. Barkin, who's also a dove, previously said he has to be convinced for a 50 basis point hike, but recently has started saying that, we are actually starting to see inflation broaden much beyond just autos and pandemic-related industries, suggesting that maybe Barkin could actually get convinced. And Mary Daly, while she's been regularly telling us, hey, we don't want to move too abruptly to potentially destabilize the economy, she's also keeping her eyes on those two dates coming up in March. March 4th, jobs report, and March 10th, CPI report, to see if the Fed's going to have to act substantially more aggressively than they had been. not so great. Especially when you start seeing the doves soften, you're probably going to get more of a unanimous aggression to deal with inflation. It's probably too soon to tell if the Fed's actually going to have any kind of split vote like the Supreme Court. How they could split votes, and then you see this dissension, and then things become a little bit more unclear. Now, the Federal Reserve did also announce that they're going to ban officials from trading stocks, bonds, and crypto, which some folks on social media are reacting to with, darn, I wish they kept trading stocks because maybe they'd keep our stocks up then. But anyway, in seriousness, let's talk about Russia briefly here. There are currently disputes in Europe about how to potentially sanction Russia. For example, Italy doesn't want energy sanctioned too much because it will contribute too much to rampant inflation, that even if there is an invasion in Ukraine, Italy's like, okay, but let's just maybe not sanction like oil, gas, and other issues with Russia because we kind of need a cheaper flow of energy right now. There's also discussion that, or the latest estimates rather, show that there might be as many as 190,000 troops near the border of Ukraine, which is a substantial increase from last week's estimate of 130,000 troops. We're also seeing new images being taken of new helicopters being delivered to sites around Ukrainian borders. We also know that there are joint military exercises expected and scheduled for February 20th, so it's possible that the new artillery being moved into place and helicopter gunships are being in a place there for these exercises. But we're also seeing new military field hospitals prop up, which folks are saying, well, okay, but maybe those hospitals are for training accidents. And it's like, all right, maybe, but some pretty big hospitals are popping up. At the same time, the U.S. again is warning of imminent Russian invasions with tanks, cyber attacks, and jets. And you have separatists in the Donetsk, probably not saying that right. I'm trying to do my best. Donetsk region evacuating as many as 700,000 individuals. And these are pro-Russian individuals who live in eastern Ukraine who are like, it's time to GTFO. We've also had rejections for bilateral and trilateral talks in this particular region between leaders and country leaders, so regional leaders and country leaders. This is a problem. When talks start breaking down and people start GTFOing, not so good. Now, we're starting to see a little bit of interesting activity in bonds, in that we're actually seeing bond yields start falling. Now, we've talked about this in prior days here, but one thing that happened here was we actually just attracted $7.4 billion of foreign money into our treasury bonds. This is one of the largest inflows that we've seen over the last decade. And oftentimes, this could be a sign of fear. And when you get these sort of inflows, especially into the 10-year treasury, you will see yields come down. That's because as more people buy these bonds, the price of the bonds goes up, driving that yield down. So even though the stock market is falling and folks like to say, oh, well, when yields go up, tech goes down, tech's still going down today, despite the fact that yields are going down. So that relationship doesn't work too well, especially because we have to consider that foreign flight to safety aspect. Now, obviously, inflation fears are continuing, and there are a lot of folks that are referencing this idea that, oh, well, inflation was so high. The CPI reading year over year was so high in April of 2021, then maybe what that means is we'll have a lower read this April, that maybe that's when we're going to see the peak. So unfortunately, you have to go under the hood a little bit more here to understand this. But first, we got to talk about Masterworks, and then I'll show you the trick here. In 2019, Jeff Bezos bought Hurting the Word Radio Number 2 by Ed Ruscha for $52 million. That's right, $52 million. And you might think that's a lot for one painting, but what if I told you this price made total sense? Problem is, we're not all like Jeff Bezos. But I did find this incredible investing app that allows you to invest in art. It allows you to invest like Jeff without needing billionaire status. And it's Masterworks.io, the first and only art investing platform. Here's how they do it. Masterworks buys artwork ranging from $1 million to $30 million by artists like Banksy and Picasso. Then they securitize them with the SEC, which basically means send them over, slice and dice them, and allow you to buy shares on their site in an initial offering similar to an IPO. Once you've bought a part of your favorite piece, you can then hold on to it until the piece is sold, at which point you can cash out, or you can sell your shares on the secondary market to someone else beforehand. So if that sounds interesting to you and you're looking at diversifying your portfolio away from the madness of the stock market a bit, it's important that you check out Masterworks.io. Now, there's a link in the description down below, and I'm going to show you how easy it is to skip the waitlist. So here's what you want to do. You want to go jump on over to a browser and just type in masterworks.art/Kevin. That's masterworks.art/Kevin. And if you click this, you're going to be able to click this button right here that says skip the waitlist. And now we're going to fill out this information. So I'm going to go ahead and throw in some of this information right here to submit my application. Kevin, and I'll throw in my email address. It's nice and easy to do here. We'll make a quick password that we can remember. And then once this is filled out, we're simply going to press the button right here. That's request invitation. Now that was in real time there, my submission. There we go. Now we're going to fill out a little bit about our investor portfolio. So let's go ahead and throw in here how much I'd consider investing. How about, the usual? There we go. And when are we planning to invest this? Well, of course, immediately. Most of the time, if we're looking to diversify, we want to get this done right away. Now, the next step here is to schedule a member interview. Masterworks likes to have one-on-one conversations with their investors. And this is really cool because it gives you an opportunity to learn more about the mechanics of Masterworks and to speak to an art expert. Art market expert. Really, really important. And in this call, you can learn about the different artist markets, their cultural significances, and how they've appreciated over time, their historical performance. You can also learn about the market-driven thesis as to why Masterworks selected certain artworks. Now, once you're approved, there are many things that you can do. The most important, obviously, is finding something that you're interested in. And you can view a lot of information here. You could pop open the SEC special purpose vehicle document, so that way you can see exactly what's been registered with the SEC. You could review the deal sheet on the history of this particular artwork. This one here from Richter from Germany. And you could see the initial offering in this, but maybe you don't want to pick this one. You prefer the investment thesis of the same artist from whom Jeff Bezos invested in art. And you could read the investment thesis on Ed Ruscha's painting here. So you can take a look at the various different options that you have here once you are approved. So go check out Masterworks in the link down below. Use my link and you'll get to skip the waitlist. Well, thanks Masterworks for that. So let's get back to this here. Look at this, okay? Folks, what they're doing. Let's zoom in here. This is St. Louis Fed. All this is the nominal CPI read. Remember, this is a basket that starts at essentially 100, and then how much does the basket cost year after year after year, month after month? And the basket doesn't cost $100 anymore. The basket now costs $281, right? So anyway, what some folks are saying is, hey, well, inflation really started popping off in April of last year, right here. You see this increasing slope here. And what we can do is we can actually edit this graph just to see this a little bit easier here. Let's do percent change from a year ago. There we go. And then let's get a little bit closer. So that way you could get a little bit of a better idea in terms of what people are thinking. So see this blast off right here in March and April right here, this explosion in inflation? Well, folks think that maybe when we lap that here and we hit April and March here, and I know I'm blocking it a little bit, there we go. When we hit April and March over here, maybe we'll have a lower inflation read because we'll be comparing to these already higher points. The problem though, folks, is this section right here is high, not because inflation was necessarily high here. It's because we were comparing back into this hole. Look at that hole. See April over here? This is the percent change right here. So of course, when you compare into this whole of the pandemic, you're gonna have a high inflationary read right here. So this hopium, unfortunately, that, oh, well, inflation is definitely going to peak because look how high it was, these spikes that we're gonna have to compare to, that might call for lower inflation. No, that was just us coming out of a hole. Now we gotta report the inflation that's coming on top of the hole. It's a disaster. So as usual, when it comes to economics, things can go so deep, and it's very simple for folks just to look at like surface level information and say, oh, see, there's good news. Look, I want that to be good news too. That's why I researched this. I'm like, is that good news? And then I look, I go, no, can't use that as good news. It's exhausting. Anyway, this morning we had Roku complain about a lack of TV panels and expensive shipping costs. They also said something that no investor wants to hear. This is obviously a very big Cathie Wood position here. This is something that no innovation investor wants to hear is the following, quote, "We've taken our foot off the investment gas pedal," essentially just to get by right now. In other words, they're not investing in innovation or CapEx, even though they're an innovation company, because they're dealing with all these inflationary costs. DraftKings gave us low guidance on users and higher costs. It's all about the guide with earnings right now. Fox News, I mean, this is no surprise. They're passing out more inflation FUD, talking about how our Defense Department is, and the Wall Street Journal did a piece on this like 2 weeks ago, so I feel like they're 2 weeks late on this, but whatever, about how essentially the Defense Department is burning through the money that our military has much faster because they don't hedge against inflation and they're getting screwed. So unless Biden gives the military a larger budget, our military is going to start having to cut thanks to inflation. Redfin also complained about higher construction costs, which is something that we've heard earlier this week as well from the National Association of Home Builders. Unfortunately, Redfin is still in that iBuyer world where they're still doing flips. And these are money-losing flips that they're doing. And the costs of materials are just absolutely destroying them. Remember, Zillow got out of this business. And that's actually treating the Zillow stock quite well. Ford briefly talked about the idea of maybe considering splitting the Ford electric vehicle business from the Ford ICE business. But they seem so confused about how to reorganize, whether to fully reorganize or to internally reorganize, that a lot of people are just throwing their hands up wondering, what are you doing, Ford? And then investing in a Tesla. Now, I do want to give a small, quick little update on my portfolio. Look, obviously, since I sold, a lot of my stocks that I was holding are down substantially more. One of the ones that's up a little bit more from when I sold, but fractionally only, is Enphase. Enphase is sitting around at maybe like $4 higher than what I sold. I mean, we're talking about 2% here. But otherwise, I hate to say it, Tesla's way down, SoFi's way down, Robinhood's down, Matterport's down, whatever. It sucks. I feel so bad, and I know that there are individuals out there who are like, Kevin, how could you say buy the dip and then sell? Look, I never told people to buy the dip while I was selling, right? I was buying the dip because that's what I was programmed to do. I always buy the dip until all of a sudden it hit me that this JPOW crap is probably going to lead to a really bad 2022, long story short, right? And this potential cyclical change that we have to deal with, and now I'm waiting for a U-turn, to where I decided, I gotta get out. And I told everybody about that within 36 hours. I don't know, I don't feel like I can do any better than that. But a very brief update on my position. So, and I hate being transparent because then people like overanalyze everything I do, and they're like, oh, well, if you would waited a day, you would have gotten a better deal. Or, oh, well, if you did this. Shut up. Like, people are so wanting to comment on other people, and it's so toxic and nauseating because it's like, you get off your ass and do something. And people just want to be little keyboard bullies. Anyway, so I did buy some long positions, and not much. I don't want to be more than 10% long. And so right now my portfolio consists of 7.5% long shares. That doesn't mean I won't trade them. It just means that those are bullish. Long means bullish shares. I am 2.5% in gold. I'm 0% short, and the rest is cash. So that puts me at about 89 to 90% cash still right now. And really building a little bit of a long position is not a signal at all that we've hit any indication of a U-turn, because we haven't. I just decided I didn't want to be 100% cash or 95% cash. I wanted to be more 90% cash. So I built a little bit of a long, a little bit of gold, and then the rest is cash. So just a little bit of an update for you there. Now let's do a little bit of technicals, okay? So first, let's look at BTC here. And now, one of the things I gotta say about BTC is we're in a disgusting no man's land here, okay? And I hate this. I will say that, first of all, hats off to BTC. It has performed substantially better than the QQQ over the last, I would say since probably the beginning of January here. I mean, look at this. From the beginning of January, from January 1st, BTC is moved from about 45,000 to about 40,000. Okay, so let's go 40 divided by 45. That means we're down about 11% here right now. QQQ, which is our technology index here, we go to the day chart and we go to Jan 1. Our QQQ on Jan 3, because there's no opening on Jan 1, it was about 399. Now we're sitting at 343. 343. Hey, like the studios that does Halo. Anyway, 399. That puts us down about 14%. So pretty wild to see BTC actually outperform QQQ when QQQ, the NASDAQ, is supposed to be a diversified way of getting exposure to tech. And BTC is generally deemed to be more of a risk asset. Well, BTC is kicking the NASDAQ's butt. That's wild. Absolutely wild. Now, going back to BTC, because we do know that the QQQ is, again, still sitting well under the 200-day moving average. In fact, we just had a cross here, by the way, a little bit of a death cross. I'm just seeing this now. Look at that. Oh, wow. Take a peek here. You got the death cross here between the 50-day moving average moving below the 100-day moving average. Death cross sign right here. Let's jump on over to BTC. BTC did break our 42,000 support. That's not ideal. Oops, I think I actually deleted the 42,000 actually accidentally before I made this video. But anyway, we had a shelf over here at 42, which we rode over here in January. We rode it briefly here in mid-February. And now we're in this no man's land where if we don't get back to 42, it is quite possible that we could get back into this 37 region, which I have to say, I'm very impressed that we did not break well below. I mean, with the exception of liquidation days where we went down to 33K, we didn't break as low as we did in the last down cycle where we went in the summer down to about 28K. So in my opinion, this is a higher low for BTC, relatively a bullish thing for BTC, and especially since BTC isn't moving as miserably as QQQ, I just have to say I'm impressed. It's very, very good. Let's look at Tesla on the 1 hour here. We're gonna jump on over to Tesla on the 1 hour. It's obviously down 3% today. But what I wanna show on the 1 hour here for Tesla is this 880 line is really weakening. It is really weakening. It is continuing to get tested, and we continue to break below it. This is not a good sign for Tesla. We regularly hit. See, look, here we are in December, bouncing off of the 880. We've regularly bounced on numerous days here on January 26th. We bounce in the pre-market, the aftermarket, during the day. We regularly bounce off of this 880. And sometimes we rubber band around it, whatever. But this break off of the 880, not so bullish for Tesla. Yesterday, we were dancing around that 880, and I actually bought a little bit of Tesla slightly above the 880 because I thought, that's all right, we've got a support line here. We're breaking that. Now, obviously, we're getting worse news here from Ukraine and so on, so maybe that's why, or people are getting more and more pissed off about the Fed, but whatever, it's pissing me off, but it's just the market that we're in. Now, the SPY, another thing that's nasty over here at the SPY is if we zoom out to the day chart, you're gonna get my Fibonacci retracement. Now, let's zoom in onto the day chart. This is the Fib retrace here. And one of the things that's, yeah, there we go. One of the things that's nasty here is that we regularly have been bouncing between the 38.2 and the 61 line. You can see we continue to get rejected at the 61.8 Fibonacci retracement, and despite the fact that we rallied out of the end of January lows, where we were essentially at the 0 level, which is at about 420, we rallied right out of those to about 61.8, got rejected, fell down under the 50 all the way down to 38.2, ran right back up to the 61.8, got rejected again, went to go chill out at the 38.2, visited 23.6, came back to 38.2, back to 23.6. This is not good, especially since right now we just had a little wick down to potentially that 430 support level, which is not actually on the Fib. It is just an intermediary support level that we have here. And so there's a fear that if we break this 430 level again, and this Fibonacci breaks down, that we're heading right back to 420, which is possible if there are escalations in Ukraine, that we're going to see that 420 get revisited again. Affirm on the day chart, folks, there's no support. There's just no support. I hate to say it, there is no support for profitless companies right now. Lemonade maybe has some support, around this like 25, 26 region right here. But come on, folks, we've played this game before. Look at the channel that we drew between 44 and 39, and it got laughed off, and we ended up moving down again. Until we get confirmation that we can actually bounce off some floors here on these small caps or money losers, stay away. I hate to say it. Palantir is no exception. SoFi, unfortunately, I hate to say it, no exception. It's breaking all of the levels that we have. And it's sad. And those are red flags. Technical levels aren't impervious. They're just a warning that when they get broken, you got to move. The same thing is true about Matterport. I hate to say it. It's a great company, but the profitless companies are just getting smoked. Matterport is actually up about 4.5% today, but who cares when this is what your chart looks like? That's like cheering about Robinhood being up, which it's not today. And this is the day chart that you're looking up for Robinhood. It's miserable. Do we maybe have a floor somewhere around $12? Maybe, but this is what you're betting on. We tried a floor before. We tried a floor at $40, and this was a pretty solid floor. Sorry, profitless just is not what people care about in this market right now, and it sucks. Anyway, one of the things that I do want to talk about is companies that are actually doing well though right now, and this is kind of mind-blowing to me, is look at this, for example. Dave & Buster's, not only getting off of that 30 as a floor, but actually riding high here. Macy's, a little off some of the highs that we've seen, but also riding stable. Carnival Cruise Lines, also riding stable above their support. Now, Cathie Wood calls these value traps, and I got something to say about Cathie Wood in just a moment. And she might actually be right about these being value traps, but what I call these, because, you know, I looked at Dave & Buster's, and just to give you some numbers here, they're trading for less than 20 times 2022 earnings, which is great, but they've only got $118 million of cash on hand. They've got $271 million of current liabilities, and they've got billions of dollars in deferred liabilities from like rent concessions and things. I don't understand. They're heavily weighted under debt. And the fact that they're doing so well in an environment where interest rates are expected to go up blows my mind. But what it tells me is that people might be investing in Carnival, Macy's, and Dave & Buster's and some of these recovery plays because they're hopeful. They're looking at the consumer. They're seeing the consumer spend more money than ever before going out. They're seeing Bank of America credit card data telling us that people are spending money like crazy out and about at travel and retail. Look at Airbnb. Airbnb is another one. People are so enthusiastic about this economy and this spend. But this becomes a problem and a concern when people stop spending this money, right? This falls apart when people stop spending this money, and it is something to be concerned about. So whatever, right now these are a little bit of a safe haven. Okay, what about Cathie Wood? What was I going to say? Well, I was going to say that Cathie, you know, there's this Twitter account, Prepared Remarks. They wrote that Cathie Wood owns 19 million shares of TDOC. Okay, TDOC, that's one of her biggest holdings next to like Tesla and Roku and that, right? So TDOC is one of Cathie's biggest holdings. And they looked at the daily volume here. And they mentioned that Cathie owns 19 million shares. And the daily volume here is anywhere between 2.5 to 4 million shares per day. And they say that if she took 25% of the daily volume, or like 800,000 or so, 700,000 shares a day, and liquidated TDOC, it would take her an entire month to get out of the TDOC position because she has so many shares. That would be devastating for TDOC. It's kind of an interesting point. Anyway. So some companies hitting all-time lows. We got Roblox, DoorDash hitting all-time lows. We've got some stocks like Palantir, SoFi hitting winter lows. Summer of 2020 lows. Redfin, Roku, DraftKings, Sunrun, Square, winter 2020 lows. Etsy. There's a lot of pain out there. There's just a lot of pain, and it's unfortunate that this pain continues. We have a little bit of a rebound happening here. Today is also options expiration day, and so you're seeing this increased volatility from options. And it is so much so that, like I mentioned earlier, Bloomberg's talking about how this is like pretty much guaranteed going to be a down day for the SPY, S&P 500. You see this often on options expiration day. Not always though, not always. Sometimes you get to like the quad witching days and there's less of a correlation to there, but you're certainly going to see increased volatility, and that's what we're seeing here today. I think a big test here about how much fear this market has is going to be how do we end up closing the day. And if you're watching this video later, go look. How did we close? Did the market rally into the close? Did we get above that 23.6 Fibonacci where SPY's above 434 and maybe rallying into the close above it? Or did we fall to that 430 level as people closing out positions with funds prior to the 3-day weekend? I don't know. Let me know what you think in the comments down below. Check out the programs on Building Your Wealth link down below, right next to that link for Masterworks. And folks, if you want to join me in those everyday market open live streams, see what I'm thinking about first thing in the morning, any program will get you into those, link down below.